Tiger Global used to be a public markets fund, and then they were doing IPO pre-funds. So the latest stages, Series D, Series E, and now they're doing a seed check in my company. I was like, oh shit. I don't know how I feel about that, right? Makes me sound very smart.
Welcome to Brave. Learn from Southeast Asia's best tech leaders. Build the future, learn from our past, and stay human in between. No BS on success. I'm Jeremy Au, venture capitalist, serial founder, Harvard MBA, science fiction nerd, and dad of 2 daughters. Every week, we debate startup news, interview changemakers, answer listener questions, and share personal insights. Join our movement of over 40,000 members and get transcripts, resources, and community at www.bravesda.com. Stay well and stay brave.
Legal liability. So they delegated responsibility to GPs. The GPs are the ones who do receive that committed capital from LPs. They have legal liability. If they don't do the due diligence and so forth, they are responsible for it. And there's a certain structure about the capital that we talked about. And then we also talked about how that capital eventually rolls into startups across the portfolio. And the key thing that we understand is that VCs are hunting for home run returns. They're looking for companies that have high growth rate. They're expecting some sort of reasonable valuation. But there are many companies that actually fit that profile. So WhatsApp was about 50x returns. Zoom was a 20x returns, even for relatively late stage investments. Those investments were even better if you look at it for the earlier rounds. But the key thing about having is that these are great opportunities, but they're only looking for 1 or 2 home runs per portfolio. And so we talked about the power law where, most of life, we know there are people who get A's, people get F's. There's a bell curve that we see here in most of life. But VCs are looking for power law returns because only a very few number of startups, from Peter Thiel's perspective, can actually get a supernormal profit or monopoly profit. Now, again, I'm not saying they're monopolies for the legals here, but when we look at, for example, budget airlines, and the airline industry is perfect competition. Most airlines don't make money consistently because everybody can make their own airline. It's very competitive. There's no way to make a lot of money. Whereas if you look at Google, you look at Facebook, you look at the Magnificent Seven in their stock market, they're able to command a premium way superior than what their fundamentals are. So these are power law returns where we basically have trillion-dollar companies. Bezos that shared on WhatsApp. He was so cute in 1997. Very nice, very cute. He asked him, who are you? And he's, I'm Jeff Bezos. So nice. And then suddenly, $1 trillion later, super bulked out. He's on his second wife. He's looking super jacked, more than me. But the thing is, someone like him, it's part of that power law, right? And something like Amazon is able to capture way more return. That one company at this end of the scale of a bell curve has captured a lot more profit than everybody else. And so we talked about how that shows up in different parts of the industry. For example, only about 4% of companies generate 10 to 50 times return in a profile. We also looked at a different set of data that showed that, again, maybe about 6% of number deals create 60% returns. But the key thing that we're trying to say here is that there is actually a very lopsided dynamic distribution here. And so we talked about how this is similar to the whaling industry because structurally, they were hunting for whales, which was, again, very risky, like hunting for unicorns today. And so we talked about how when each bet has a very high amount of risk, but very high reward, the most logical sense is that we bundle that risk into a portfolio of risk. And so as a result, it generates a different set of returns. And we see this happen over and over again in different industries. It also happens for blockbusters, for movies. Some films make super normal profit, and then most of them do horrible. Similarly, for the entertainment industry, Hollywood actors and actresses and supermodels, they also have the same power law dynamic. Some of them will become household names, and most of them will be nobodies. I think we have to think about how, as a result, talent agencies have a portfolio of talent that they cast. Similarly, you see the same for movie studios where they're funding a portfolio of bets. They always have 20 or 30 that are always in production, and they're shopping around trying to make bets on the right people to make it happen. And so we talked about how VCs collaborate across stages, but are competitive within stages because of the limited number of opportunities. And we'll talk more about that in time to come. And as a result, I provided a bit of yardsticks in Southeast Asia because people are asking, what is a seed investment? In general, that'll be like a $1 million investment. But of course, what we shared over WhatsApp in our group was that Ilya, who was the technical co-founder and CTO of OpenAI, tried to orchestrate a board ejection of Sam Altman. Microsoft had to step in. Eventually, the coup failed. Sam Altman was restored as CEO. And as expected, Ilya, who had voted against Sam Altman, eventually left. And his seed round was only $1 billion at a $5 billion valuation, right? Crazy if you think about it. It's like seed round or pre-seed round is $1 billion. So again, definitions are always there, but it's interesting for folks to be aware of. There's a thing that we often say is that you can always divorce your spouse, but you can't divorce your investor, right? So in the sense that once you have sold your 20% to X number of investors, there are these legal rights, information rights, it's actually very hard to clean up. And so there's a lot of horror stories amongst founders. And you can argue that the VCs or whatever, but literally just like last year, talking to the thing, and then it was basically like they had to sell the company. Let's just say it was like 20 cents on the dollar. So the investors would probably lose 80% of money. But one guy was like, no, I do not accept that. So he vetoed the whole thing. And then now he gets nothing off the dollar, right? So everybody else is angry. So I think we need to think about rights in two major ways. Or I'll say two major axes. One is the rights around my pot of money to supervise my pot of money. And the second set of rights is my set of rights to control the direction of the company, if that makes sense, right? So because that informs everybody else. And then the other axis I'll probably look about it is positive, which is I want to change you towards to do something, versus negative controls, which is veto rights. I want to block you from doing something. So you always have to be thinking about those sets of rights, and you have to be very careful who you give them to, because the other axis is that guy a joker or a rando, and literally there are people in Southeast Asia that we know, we're like, man, this guy's horrible, right? Because there's all these horror stories that we hear, and we don't know whether it's true or not, obviously, but we hear it, play poker with each other, and we're like, okay, probably don't want to do business with that guy, or that corporate VC has a certain set of corporate incentives that may not be aligned, and so you have to be watch out for that. So you have to watch out for these pieces, and I think that's where your reputation is really important. So I think from a legal perspective, again, it's control over your money versus the direction of the company. The other one is positive controls versus negative controls, veto rights. But the other axis is really important. Is probably your reputation, like the trust or credibility. Because if I trust you a lot and you're the guy who always does the right thing at the end of the day, then I can give you a lot of rights on both ends, right? But if you're like a total asshole and we all know it, everyone's going to try to negotiate and haggle with you about what those rights exactly can do. So imagine that you are basically raising a fund. So the formation of a fund. Normally, emerging VCs will take about 3 funds to become an established VC. So the first VC deck that you build is very much based on relationships. So Fund 2 is normally raised based on momentum. So normally the second fund is raised about 2 years after the first fund is raised, 2 to 3 years. Now, the tricky part, as we talked about, is that it normally takes about 10 years for a company to hit a unicorn stage. The second fund is very much unclear whether the portfolio that was selected based on Fund 1 actually has a home run or not. So Fund 2 is normally raised based on momentum. Maybe there's some interim metrics like, oh, my seed investments that I made have now raised Series A, Series B in the past 3 years. And so I'm raising based on momentum. I don't know if they're going to be a unicorn eventually, but I'm very confident that they are. So it's based on momentum, but also based on the trust of the manager. And lastly, of course, with Fund 3, is normally about 6 years after the first fund. By then, it will be quite clear whether there are companies that are on the way to the trajectory to become a unicorn or they already died by then. And so there's a lot more data for the LPs to evaluate the VCs. There are different perspectives. There are some institutional LPs, limited partners, for example, Temasek sovereign wealth funds, that they tend to be larger on average, will only invest in the latest stages when there's demonstrated performance. Sequoia has been around for dozens of years. A lot of these Cell and all these other funds have been around for dozens of years. There are lots of data. They have a proven leadership team, proven succession planning for the leadership team. They are investing based on historical fund performance. But however, what the research has shown as well is that the best performing funds tend to be early funds. Fund 1, Fund 2 tend to be the best performing funds. And there are lots of debate about why Fund 1 and Fund 2 tends to be highest performing. Some people say it's because Fund 1 and Fund 2 tend to be built by people who have left the industry and therefore have a strong insight about the industry. And often these, again, as Darius has asked, these industry trends have a limited lifespan. Does that make sense? For example, we saw that in crypto. There were a bunch of people who were very nerdy. They were crypto, and then they built their first crypto startup. It was not so good or great or whatever it is, but then they became crypto VCs very quickly. The fund crypto VC did really well. But now if you look at a lot of the crypto VCs, Fund 3, Fund 4, they're performing not very well because crypto as an industry has gone through that boom and bust. So these Fund 1s tend to outperform because an early crypto adopter and influencer and leader jumps to become a VC. They have all the knowledge. They have all the friendships with the founders. So they're able to monopolize and they have the insight about how to put that bet in. So it's not a 1 in 40 bet for them. It's not roulette for them. For them, they're like, this is a 1 in 2. I know that Bitcoin is going to go 10x over the next 10 years. It's a no-brainer. Jeremy from UC Berkeley, who shared on this idea last week over drinks, is a total loser. He believes in gold. What a lame-ass guy. For sure is going to win. This is not a 1 in 40 chance. This is a 1 in 2 chance. I just got to get as much money, and he raise that money, and he get leverage from other people to make bets on something that I know has upside, right? So there'll be an argument for fund one. There's also an argument for other end is that later funds, the managers become more professional, more institutionalized, and then the argument is they become lazier, they have more filters, they're more distant from the market. As a result, you see the LPs, there are LPs that are interested in investing in emerging general partners or VCs on one end, and there are other funds that have a mandate that they can only invest in later stage. But of course, when you're a later stage fund, in order to raise funds, you probably are very successful, you're a very large fund, you may only have reserve access for the people who believe in you in the early days. So if you look at Sequoia or these other late stage funds, the minimum check size is like $10 million, right? You can't get in unless you were their buddy from a long time ago. Does it make sense? So that's how the game is played a little bit. An emerging VC will say, I'm such a hot shot, I know what's going on, now's the time to come in. If you don't come in, you may not be able to come in the future because I'm so successful, right? And so it depends on the relationship and the background of the VC. So if you were setting up as a VC fund and you're building those decks, you think about it in terms of 3 to 4 major phases. The first thing is you plan your fund, you design a strategy. So that's what this course would be over the next 7 to 8 weeks. You'll plan and prepare your fundraising materials. You prepare this fundraising deck. You'll get input from people. And then you build a target LP list about who you want to do pre-marketing to. So you want to explain and tell them that you're interested. Then the second thing you want to do is you're going to do the fundraising. So you're going to go out, you're going to have a lot of coffee, you're going to have a lot of wine, you're going to go for a lot of jogging, you're going to talk to the LPs one-on-one. And then when there are fundraising guys, they're going to do due diligence on you. They're going to quickly call their buddy and say, hey, CozyKin, is he legit? And then the other guy is, yeah, he's super legit. He was the best teammate I ever had. He knows all the shit about semantic AI, and that's the hottest thing. And then the guy's great, positive due diligence call. And then you obviously build an LP base and a funnel. And after that, you close the fund, you start setting the business terms, start negotiating the limited partner agreement. We'll talk about it later, as well as some side letters. For example, if you are a very big fund, the Saudis, then the Saudis will say, I write such a large check. I don't think you should have so much money going to you because I'm going to write a large check, but you should take a smaller percentage of this large check. So you might have side letters with these. And now, of course, you close the fund, so you tell people that you should wire the money to me. And obviously, you have LP relations. You continue to manage the LP relationship, and then you always are preparing to raise the next fund. So the joke about VCs is that a lot of founders become VCs to stop fundraising, and then once they become a VC, they have a fundraise every 2 years. So it's actually quite exhausting, and people travel all the time. For example, I met somebody, we were in a barbecue, he's a VC fund manager, he flew all the way to a Scandinavian country, and he was like, you should invest in Southeast Asia. And then the person was like, oh, I know about Southeast Asia. Oh, how do you know about Southeast Asia? And then she was like, I listened to the Brave podcast. And the guy laughed and said, oh, actually, I know Jeremy, right? The reason why is that a North Scandinavian LP, she's not interested in my podcast per se, but she's interested in saying, okay, I have money allocated to China, TBD, global decoupling and trade war, USA, are we tapped out? So they have to explore new geographies, India, Southeast Asia, new geographies to invest, right? New asset classes to invest in. So you're always having to manage your relationship over and over again. So there are 4 major fund strategies that you see. And so every time you meet a VC fund, you can probably bucket them into these 4 categories. These would be your index portfolio, your relatively standard or concentrated bets. Then you have multi-stage. And then lastly, you have venture builders. If we're only simplifying to the first 2, which are the most standard type. Of course, the most famous tend to be the multi-stage, I would say. An index portfolio is basically spray and pray. So as a result, what it means is that spray and pray is a derogatory way of saying it. But basically what you're saying is, I believe that this industry is there, but it's very hard for me to tell which specific winner. I want to go wide. I want to go for lots of bets. I probably sacrifice some of my alpha in my ability to concentrate my bet in the winners. But I think that my belief is I need to optimize widely because I don't understand the market, but I believe that this industry will have big lift overall, right? And this tends to happen especially earlier. So you look at your seed stage companies, your early pre-seed stage companies. These tend to be the earlier stage because it's hard to tell when you have founders that only have a pitch deck. It's very hard to tell which one you should really concentrate on. So these tend to be they tend to lean wider as a fund. And so these will tend to systemize their support, and they probably tend to have batching to simplify the operations. So Y Combinator is a good example of an index portfolio. They have like 100 startups, right? And everybody pitches. In terms of the selection interview process, I've interviewed at YC 3 times. I got rejected 3 times. Then I went off to raise my seed and my Series A. So I said, fuck it, I'm never going back to them. But in each time that I interviewed at YC, the interview was about 5 minutes long, right? You know what I mean? They're not doing a ton of due diligence. They had a presentation. They had 5 minutes to evaluate me. So they tend to it's more of a numbers game, you can say, to some extent. But there are different ways to play that numbers game. The second type is a concentrated bets. So these tend to be less companies. They tend to be more conviction. So these tend to be about 20 companies on average, maybe as low as 15. But normally below 15 is probably bad news because you're too risky. But these tend to be more conviction. And then the argument that you say is, I really understand this market. I know I can pick the winners in this industry for whatever reason. Okay? And so I want to write larger checks and I'm going to support them more. And because I have more money in each of these companies, I can take on more work. I can take on, like Siri and us, I can be on a board to control it, to control the destiny of my money, to control the destiny of the company. Because I wrote a larger check, I deserve a larger side. And then as a result, I had more control rights, more support. So imagine if you're Y Combinator and you're doing thousands of companies effectively across 5 years, then you don't have ability to support. So you lean on the community supporting each other. Does it make sense? Whereas if you are Sequoia, Lightspeed partner, or SoftBank, then supposedly they're going to sit down with you and make this big bet, right? And talk to you about a strategy and give you that time. So concentrated bets. So there are different companies like Monks Hill, Nextview Ventures, Haystack, Alpha GWC in Indonesia. For example, these are all companies that will be more concentrated. Obviously, multi-stage used to be much more hotter several years ago, but multi-stage is basically a nice way of saying is that I want to invest in the same company across multiple stages. So what they tend to see is they say, remember that curve that we showed about the views, is I see that each stage is a limited slot. So if I see a winner, I want to make sure I have the biggest bet at every stage of that company. So the seed index portfolio does 40 companies all at the seed stage. The Series A doing 20 investments will do all at Series A, around $3 million check size. The multi-stage guy might say, I'm going to do the $10 million check, I'll do the $50 million check, and I'll do the $100 million check, right? So these will be multi-stage. And so they see that these are finite pieces of ownership and they tend to believe that they can do all of it. I understand Series A, Series B, Series C, Series D, for example, right? And this was more true during the zero interest rate era. A lot of companies became multi-stage. And then now with high interest rates and the fact that people realizing that it's actually much tougher to make those returns, people are retreating into their zone of competency, which is I'm very good at the $10 million check size. I'm very good at the $50 million check size. And then people are, as a result, collaborating more with each other at different stages. So 3 years ago, I did an angel investment in one company. And then the next thing, the founder called me and said, Jeremy, I received my seed check. And I was like, congratulations, who did you get it from? And Tiger Global. And I was like, Tiger, for those who don't know, Tiger Global used to be a public markets fund. And then they were doing IPO pre-funds. So the latest of stages, Series D, Series E. And now they're doing a seed check in my company. And I was like, oh shit. I don't know how I feel about that, right? Makes me sound very smart. But then I was like, I don't know if Tiger Global really understands how to write $5 million check, because they normally supposed to write $50 to $100 million checks. But during that time, they did. So anyway, but now you see people retreating now, right? So because when Tiger Global took the deal, they took the deal away from companies that could have done the Series A, Series B, Series C, because they were supposed to be in their lane, quote unquote, in Series D, Series E is the zone of competency. And I think we'll share some of those theses there, but we'll talk about that. And obviously the last category that we have are venture builders. So these are a new type, but basically they tend to be, what they tend to say is, we think that this market doesn't really have great founders, but we'd like the market or the industry. In other words, the VC thinks that they're smarter than what the ecosystem can generate in terms of talent. For example, so a VC may come in, I've seen them, they'll be saying something like, I believe I understand, we saw that in crypto for sure, we now see that for AI. Okay, just 2 weeks ago, I saw an AI company and they were like, we really understand, they were not, basically they were like venture builders, right? But they were like, we really understand AI and we're going to launch 5 companies in AI and we're all going to be part of this holding company, which is basically a venture builder, right? And then I was like, if they figured out, if they're so good at one of them, why build 5, right? Just focus on one, for example. There'll be the argument that you have. But I think venture builders, you see them a lot. You see them in the Philippines, you tend to see them. I think you also see them in America as well. America, if you look at him and hers, it was actually set up by a venture builder that was doing consumer venture studio by basically saying, we have insights about the consumer market. We as a team, we are going to a bit private equity-like. We're going to hire the right managers and we're going to take a larger slice of equity for that, but we're going to give them some equity. They're going to be employees to launch this idea because we have the insight, we have the support. So for example, you can see that with Rocket Internet for the big days. You may remember that a lot of folks their founders were management consultants. So basically Rocket Internet was saying, we understand the market. We believe that, therefore we believe that e-commerce should work in Southeast Asia. So let's launch Zalora. And so the bulk of the equity went to Rocket Internet, but some small slices of equity and primarily cash went to the founding team across multiple generations of Zalora. So there's one. We also saw that for Groupon as well. People were like, okay, let's copy Groupon. So they launched Groupon in Singapore, Groupon. So actually, if you look at the story of Groupon in the deal sites in Singapore, there was a set of Groupon clones that were funded by venture builders, i.e. Rocket Internet. But there were also founders who emerged naturally and were funded by VCs that were index portfolio or concentrated bets, right? To compete. And so you saw two types of folks go after that with different capital strategies as well. Now, my follow-on strategy may be that I'm going to write $10 million checks. Out of the $50 million in this pot, I'm going to write $10 million checks to double down on the winners, but I only have 5 of them. Does it make sense? So basically, what the perfect world would be, I make 20 investments. And by the way, all 20 investments, when I first made an investment, I thought it was going to be a unicorn. Does it make sense? So you must understand that when the VCs make the bet, they don't say this is a shittier bet, this is a better bet. You believe that all 20 of these investments have the equal chance of a unicorn. And quantitatively, as a VC, you know that's 1 out of 40 chance. But of course, every VC thinks they're smarter than every other VC. So they probably think to themselves, okay, I got 1 in 2 chance. You know what I mean? So you're like, oh, I got 10 unicorns in this basket of 20, right? Because otherwise, so that's that piece. But over the course of 2 years, some will overperform because they're better, and some of them will underperform. Maybe there's competitor or technology, or you didn't do your homework and someone else's competitor was better, or you thought that you believe in them, whatever it is. Sometimes the CEO gets cancer, right? And so there are actually companies that have failed because the CEO had cancer, and so the CTO had to become the interim CEO, right? There was a company called Jaibo. It did social robotics. It was basically Siri before Siri. It was basically like the belief of digital companions, and they launched it way too early, and they got killed by Alexa. So if they launched 3 years earlier, or if the guy didn't have cancer, they probably could have launched before Alexa, and they could have maybe have been acquired potentially by one of the companies. But they launched too late. They got killed by Alexa, which also chose a different product market fit iteration. We'll talk about it later. But basically, so then the bet was bad in that sense, right? So if you think about it from a VC perspective, 2 to 3 years have passed effectively. And now I'm like, ah, shit. 2 years ago, I thought I was really smart. I made 20 bets. I think there are 10 of them that are obvious no's. They didn't make it, they underperformed versus my expectation. But 10 of them are in the bucket. Maybe 3 of them are pretty obvious winners. Does it make sense? So the 3 obvious winners, like they're crushing it, everybody loves them, everything. You're like, okay, great, here's the $10 million. But probably the remaining 7, that's like touch and go, you have the ability to make those 2 bets. So that's your second bet. And this is where the people who play poker or gambling get really excited, because basically what you're saying is, at the start, you had a certain amount of information, you thought they all made sense, but then after 2 years, each company has revealed information as you provide. They have revealed information about each of them. The founders underperform, overperform, team, blah, blah. And now there are companies that make sense for me to do a sure double down or all in, but some of them is touch and go, right? But of course, the problem is that even at this point in time, you don't know. So you fast forward another 8 more years, your sure wins may not become sure wins, right? So recently, we shared a company called Bolt. I'll share it again. It was $1 billion valuation, 1-click checkout, $1 billion company, sure win, and then it fell apart, right? And now the valuation go down to 0. So it may actually be one of these companies that are touch and go right now, and that will be based on some level of judgment. Yeah, let's just say I have a 20% investment, I have a seat on the board. Tiger, come. This is a great company. But by the way, I want to sell half of my stake. And Tiger is going to be like, what are you talking about? If this company is really good and you think it's sure win, then why are you selling? Not a good excuse these days, because most LPs are extending end of life by another 2 to 4 years. It's actually quite common. So it is so people do that excuse. And so there are 2 sets of strategies. One is, if you're at year 10 and your company is relatively late stage, it's like $1 billion valuation, but there's no exit on path, I think it's acceptable. But the problem is that the secondary market normally is priced that in. So in today's market today, if you're trying to sell a secondary, the haircut on the private market valuation is at least 50%, if not 80% discount. So imagine you're like, wow, I invested X, and so my paper stake now is $10 million, let's just say, because you made a very small investment. But you want to sell secondaries, I can tell you right now that because it's an illiquid market, and this is whatever it is, the other guy will be like, yeah, you want to sell is a bad signal, but I quasi-believe, but the way I can make up for it is you sell me 20% of face value. Sell me a $10 million stake for $2 million. A lot of VC funds are getting screwed right now in Southeast Asia because they can't exit, they're end of life, they now have the reason to exit, but there's a big haircut. And if they sell the value, the loss of that paper value is immediate and will stop their ability to fundraise immediately. The key issue was that actually a lot of these companies were doing very well. In fact, my company I was working at also did very well, but it got killed by government action, right? In that sense, regulatory. Regulatory action happens all the time, which is why it's very important when you write a deal memo, you have to be very careful because, again, no, Google's making a shitload of money and the EU is going after them for monopoly power, right? Does it make sense? So to some extent, when you're a VC 10 years in the past, you're making that decision, you're like, you have to understand regulatory action is the biggest way that late-stage unicorns, private unicorns, don't achieve that thing. So we saw that for crypto as well, right? So crypto as well received regulatory action in many countries simultaneously. So a lot of people that made a lot of sense fell apart, right? So people had to think about that regulatory action. Obviously, before it happens, you have a passive strategy and you have active strategy. Passive strategy is you write your memo and you say that the risk of this is that the government will crack down on this, right? So let's not invest. That's your best passive strategy, right? Your active strategy, and there's actually VCs that have this as part of the value addition, is they will do lobbying. So in the US, there's something called Task VC. Their claim to fame is that they legalized Uber, they legalized DraftKings. They were the lawyers and regulators and politicians that were able to lobby and fight the city officials state by state. But their value add is, and I met the team, was they came to me and said, Jeremy, we'll help you legalize your market practice. And I was like, this is a strong value add. You know what I mean? Because that's the only thing they can kill, right? And if you look at VCs today, all VCs around the world have government or state sponsorship. Most of them do, if you think about it. So if you go to any emerging market VC, all of them have connections to this politician, that politician, whatever it is, okay? So it's well known, right? Even you go to developed markets, it's all legalized, it's formalized. We have Mark Andreessen and Peter Thiel and Ben Horowitz have said they are in support of Trump and Elon Musk, right? I'm just saying, what happens if Kamala comes to power is, so they better hope that they lobbied correctly in that sense, right? So I would say that VCs do have strong, because like I said, the first ever VC in the world was a government program. Silicon Valley is a nexus of university, state subsidies on manufacturing, silicon manufacturing, as well as government industrial policy, right? I'm just giving an example, right? So I think what I'm trying to say here is like the passive policy is don't do the deal if you think it's going to get killed. Don't do the deal in a geography that you think you cannot make money in based on the regulatory action or societal or cultural norms, right? Which is why I think you see depressed VC deal making in the EU, right? Does it make sense? Because they know the tax rates and they know that the EU is so strong in breaking up large companies that they don't feel comfortable. So they choose not to do deals in the EU, right? Then the active strategy is you have the ability to shape policy, because as lawyers, you will be defining policy by nature. For technology, you will be rewriting the policy because the technology did not exist 5 years ago and now people have to figure it out. So I'll give you an example would be people are now trying to get married to their AI spouses. Legal or not legal? Don't know. Nobody has ever written it. We all written a marriage is with a person. Then obviously there was the LGBTQ reform movement, whatever you want to call it. But obviously there was a huge lobbying and socio-political dynamic where the law was rewritten or updated or kept the same depending on geography. So if Danny uploaded herself to a virtual AI version of herself and gifted herself all of her assets via a Cayman key that reports entirely to Danny.ai. This AI character on my phone says that she's Danny.ai and she says that she really likes Jeremy and she wants to invest in Jeremy. Does the court respect Danny's next of kin for her assets? Or the fact that she's gifted her assets to this Delaware C Corp that agrees to do whatever this Danny says? I'm just saying there's a real legal case that is starting to happen now, which is digital avatars. Do they have legal rights? Because corporations in America have legal rights. Now, they don't have full rights. I've never seen Wendy's get married to somebody yet. But I'm just saying they do have legal rights, right? So I think we just have to be aware that part of the issue is that you have to think through what the regulator is going to be and what society is going to be.
Thank you for listening to Brave. If you enjoyed this episode, please share the podcast with your friends and colleagues. We would also appreciate you leaving a rating or review. Head over to www.bravesea.com for member content, resources, and community. Stay well and stay brave.